In this episode, we're going to discuss the changes for 2026 to the SBA 7A loan program. Now, some of those changes include changes to US Citizenship Requirements, the Made in America Act, equity infusion for down payment, seller financing, changes of ownership, and collateral requirements. Now, to help me go through all these changes, I've asked a friend of the channel, Jani Beatty of GESA Credit Union, who is an SBA Relationship Manager, to join us to discuss these topics and much more. So if you're a buyer, pay attention, and if you're a seller or a owner that's thinking about refinancing, this episode could be fairly instrumental in how you structure a transaction. So we'll see you on the other side. So Jani, welcome to the channel. I really appreciate you stopping by to help us get through the latest SBA reg updates for 2026, because there's been a few of them.
And a couple.
And last year there were at least 2 or 3 different updates mid-year without much notice. So it's been kind of one of those years where you got to be pretty agile.
Yeah, it's been a whirlwind of updates. So
Yeah.
Thank you for having me, Brent.
You're welcome. You're welcome. So everybody gets an introduction when they come on the channel. So let's do yours. Jani Beatty, SBA Relationship Manager, Business Acquisition, Financing Expert with GESA Credit Union. Now, you work extensively with entrepreneurs and investors, acquiring existing businesses, helping them navigate the SBA financing and structure transactions that support long-term stability and growth. You have a deep commitment to small business ownership and believe that successful acquisitions are among the most powerful ways to preserve local businesses, create jobs, and build generational wealth. And that is a true statement. So thank you for joining us today. So I think one of the things I'd like to do first is really just talk about, kind of go through just an overview, a quick, and then as we go through that overview of the SBA, the program, let's talk about some of the things that changes and some of the tools that are available that people take advantage of sometimes.
That sounds good. Let's go.
Okay, so maximum loan amount, still $5 million.
It's still $5 million, except when it comes to manufacturing, it's specific to the first 3 digits of the NACES code. And that was recently raised to 10 million for manufacturers with an SBA guarantee.
Yeah, so that must be part of the administration's effort to boost manufacturing in the country.
Yes.
So that's awesome. So 10 million, still a 10% down on the 10 million?
Well, that's going to go down to lender risk.
Okay.
So the program, I think it became official or put into the books maybe 3 months ago.
Okay.
I will say so far, loans that have met that threshold have been 2.
Oh, 2, really?
2, yeah.
Okay.
Because you're really judging, typically a loan that size is going to be done as a pari passu with an SBA loan and a conventional loan together, right? But I think as time goes on, lenders are going to become more comfortable with it, and probably those numbers are going to increase.
Okay, but you guys are taking a look at them.
We are taking a look. We'll take a look at any good deal that's
Yeah.
out there.
No,
if it makes
it's
sense.
absolutely. So in the M&A world, we call that senior debt and mezz financing. So whether that's a senior debt would be the SBA loan. Mezz financing might be a conventional loan or from a mezzanine lender, or it could be just a very large seller second.
Yeah, that was really well put.
Yeah.
100% right.
Yep. Okay, great. Well, that's awesome, and I hope we can send you a few.
I hope so too.
Okay. Eligibility is still around purchasing of an existing business operation, although you do have the ability to use SBA financing for startups. So partner buyouts, you want to talk about that?
Sure. Partner buyouts are, in the SBA world, they're few and far between. Not a lot of brokers know about them, not a lot of lenders know about them. They can be great, for a couple of different reasons.
Right.
One, if you are an existing partner and you're buying out a partnership, somebody that's leaving the company, you're not necessarily going to have to put the amount of the equity down payment into it. So it can
Right.
be a way to finance that. So there's a lot of different ways that partnership buyouts can be done. Whenever it comes to that, it's really best to start talking to your lender early, because we can help you with the structuring that. We can let all the partners know if they need to have guarantees,
Right.
even after they step away for the business, and what that's going to look like. So
Right.
partnership buyouts are fun. They're done not as often, but they can be very, very good
Yeah,
for
so
business ownership.
how much of the business do you need to own as a percentage to qualify?
20%
Okay.
is what you need to be able to take advantage of the program. You need at least 20% of that.
Equity.
Yeah.
Yeah, okay.
It took me a second because I wanted to make sure I was answering that
No,
right.
no,
'cause
that's
there's
right.
a couple of different ways. Like I said, it's probably the more complicated
Right.
structuring that's out there. So it's always great if you're looking at partnership buyout, if it makes sense, it's generational, it's family, it's an employee driven.
Right.
Talk to the lender so they can look at the SBA guidelines, which you mentioned are quickly changing.
Yeah.
So
So it used to be 10%, and it changed to the 20%, or excuse me,
did.
preferable 20%.
yeah.
So I think the great thing about SBA is the rates are pretty reasonable,
They are.
and it's on a 10-year term. So, and real estate's on 25. Can maybe talk a little bit, when you're buying a business and there's real estate attached, how do you blend those, or are they two separate loans?
Well, you bring up two really good points. One, when it comes to terms of SBA lenders versus like a commercial lender, when you typical commercial loans are going to be for 5 to 7 years, right?
Right.
SBA loan, just on the goodwill portion of the business, so we're not talking the real estate, is a longer term. It's 10 years out there. And then if you combine the real estate, so I have a couple of these that I'm working on right now where we have, real estate and the goodwill of the business or the acquisition of the business. If that real estate is 51% or over, then the whole term, including the goodwill portion or the acquisition of the business, is now 25 years.
Oh, wow.
Or, for example, I have a business, to be really specific, or I'm doing a blended term. So what we have is, I think I want to get the goodwill on it's 900, and the real estate's around 400. It comes to 17 years.
Okay.
And that's the blended term. It cash flows better that way.
Oh, sure, absolutely.
Yeah, it's a really powerful tool that we can use when it comes to financing and acquisitions.
And just like the partnership buyout, when you're doing something like this, it's always good to talk to either, obviously, a lender that knows what they're doing to help you structure it, or a really good business broker or M&A advisor.
That's why I love it when I get a phone call from a broker like you, Brent, when you're asking, hey, Jani, I've got this business, I have the real estate with it. Can you figure out what the blended term is going to be? Because it's going to help you with your sales price and your marketing out there.
And for some businesses, if you have the opportunity to buy a building, a facility, it makes a lot of sense. If you're a retail location, maybe not, because you can move that retail location. It may not be site specific. But if you're a manufacturer or a wholesale distributor, so think about all those different things. If you can purchase that on your exit, when you sell the company, you've got just that much more equity built in, plus a much better cash flow. And the business bought the building, basically. So,
absolutely. And if you can't purchase at the time, try and fit in there a right of refusal if it's a property that you need that's adjacent to your business, like for the manufacturers, especially businesses. It's a great way to do it as well.
So down payment is 10%, kind of.
Kind of.
So there's got to be an injection of 10% equity, right?
Yes, at least the minimum 10% equity injection.
Now, you can do, and this is where we get into seller notes.
Yeah.
So traditionally with SBA loans that Bill and I are involved in the transactions that we do, most of the time it's a 10% down coming in the form of cash from the buyer, and there's usually a 10 or sometimes 15% seller second behind it. And those, we can talk about seller seconds in a whole episode.
We could just go on for
you can
days
be very
on that
creative.
subject, right?
But for the 10% down, if somebody could theoretically get in for 5% down if you have a 5% seller second, but here's the key. You have to put the seller second completely on standby for 10 years.
Yeah, it used to be different where you could do, you know, 10% equity injection essentially by the seller,
Right.
and finance that for 10 years, and they start getting the payment, the payment stream back to them right away. But that was updated like a lot of SB updates, and as you've mentioned now, 5% minimum injection if you have a full standby on the 5% from the seller injection. How many times do we see those now?
I have not seen one
I have
yet.
not seen that.
Yeah, no, and you know, some of the standbys make sense. So occasionally I'll see a standby on a seller note for like 2 or 3 years.
Yeah.
And that's coming at the request of an underwriter who may think it's a little tight, and by giving the business 2 or 3 years of not paying that second, and just making the SBA payments, they feel a little safer. So in some instances I'll see it where, and this again, not necessarily an SBA guideline, but this gets down to when credit administrators put overlays or your underwriters are looking at risk.
Well, I think what we do and what you do too, and we talked about this in a prior conversation, is we want to make sure that we're setting our buyers, these are our entrepreneurs, these are the people that we're supporting up for success. And sometimes when you have like a manufacturer or a contractor of some sort, they're buying the business cash free, debt free. You're not taking those ARs with them necessarily. So they're starting out in a low cash position. So you want to make sure that they're going to have, whether you're funding it through working capital, or for the example of that underwriter is like looking at that going, perhaps we should push that seller note out for a bit to make sure that our buyer has enough capital to operate this first couple of years while they're building up their reserves.
And so usually what the structure of the seller note is, really it's on standby for 24 or 36 months, and I don't know what the qualification is now on how long it has to stand by so that those payments aren't counted in the debt coverage ratio.
Well, I actually don't like to do it like that, because what I don't like to see are balloons from my buyers. So if I can do a 10-year seller note that matches the term of the SBA loan, I'd prefer to do that than a full standby or an interest-only structure for the first so many years. I think there's more leeway right now with how we can structure seller notes than there was before. So for example, we used to not be able to do balloons on seller notes, but the SBA does allow that. It's kind of in the gray. So I have one we're going back and forth right now. There's multiple letters of intent out for the business, and we're starting with a 10-year structure on that seller note, which is a substantial seller note.
It's usually that's the standard way everybody does it.
But in the background, I have said to my buyers, because my buyer is cash flow, he's got plenty of assets in terms of liquidity. He's very strong. The company's very strong. Cash flows really well. If you want to negotiate that for a balloon, that's okay with me.
Okay, good. Again, this gets down to working with your SBA lender when you're trying to take a look at it, in putting a structure together. The standbys are interesting in that they can be fairly flexible and can kind of help you make deals work. So borrower eligibility, it's got to be a business for profit, U.S. based, but the buyer has to now be a U.S. citizen, and that changed recently. It's kind of been ratcheting down over the last 3 or 4 years.
It surprised us. Like you said, SBA updates are coming a bit fast and furious without a lot of notice. So impactful, because long-term permanent residents can serve in the military, paying taxes, and we're, as of March 1st, we got this at the beginning or the end of January, we can't do those loans anymore. And the impact is, it's significant in the industry. I think just personally, it impacted 3 of my transactions that I'm working with. But we work with what we can in SBA lending, and we move on.
The other thing is no prior SBA loan defaults, and this is a hard and fast. So if you've ever defaulted on an SBA loan or any government obligation, regardless if it's non-SBA, you're not going to get an SBA loan.
You're not going to get that approved, absolutely, no.
And so here's the other one, demonstrated management compatibility. So this is one where Bill and I'll be really honest. If we know we've got somebody that doesn't have direct industry experience, and we talked off camera about the plumber, right?
Right.
So somebody buying a plumbing company could be a fairly good sized plumbing company, doesn't necessarily have ever been a plumber, but may have been in the construction industry. There's nothing, and they can run a successful business, right? So being a plumber doesn't necessarily mean that only plumbers can buy plumbing companies, right? So other people can.
Yes.
But there are some SBA lenders that are really picky about this, and this is one of those things where if you've got an individual, and this is really up to the broker, is really to just qualify those buyers as they're coming through.
Yeah.
So do you have a skill set that lends itself to running a manufacturing business or a plumbing company or something of that nature? Is your skill set as a person, an individual, is it transferable? Because it is one of the ways, if you're a programmer at Intel and you're going to go buy a construction company, that's probably not a good fit. It
Probably
might be,
not a great fit, but could be. And I think this is where, between the broker, the lender, and the client, you can be educating your credit administrator too.
Right.
So, you want to be able to put together a robust reason why this person can, for the plumbing company, why, even though they're not a plumber, they can manage this plumbing company successfully, operationally. If they've had, if they've run divisions or their own companies before, they've done the management, the leadership, they've grown it, and they've been responsible and overseeing all the operations. Is that transferable? Yes. It's up to the lender to make the case to the credit administrator, who's going to say, this is not a plumber. Tell me why this person is there.
So the other piece of this is the business, right? So a lot of small businesses don't have a lot of deep infrastructure. When I'm talking about infrastructure, I'm talking about management in the company that's not the owner. Right? A lot of businesses, the owner does a lot of things. But if the company's big enough, say revenues 2 million plus, traditionally there is some level of management. So if you've got a good infrastructure in place, that where the owner goes on vacation, 8 weeks a year, just disappears, and the business runs itself, right? That's a good that's something that the broker needs to point out in doing that. The other one is negotiating the owner staying on for a period of time, because, and I will tell you, I just closed a roofing company where the two buyers came out of the tech business and they bought a roofing company. But the owner signed an employment contract for 1 year. And they hired some infrastructure to help them with the bidding process. And so we were able to get it through and get it funded. It wasn't the easiest transaction I've ever done, but it is, if there are enough factors, and if you've got a good broker that can outline those factors, infrastructure, the owner staying on for a period of time and staying involved in the business is a really key factor. So ownership and control. So you've got to buy, if you're doing a partial, if you're not buying 100% of the company, you have to take at least control of 51%.
Right, yeah.
So the other part of that is when you get to guarantees, if you're retaining the 49%, you're going to have to personally guarantee the loan along with the buyer.
Yes.
So then that's where usually these things start to unfold and you get to a much higher percentage of ownership.
That's, that is where those partnership buyouts, again, we talked about this earlier, talk to your business broker, talk to your lender. These things do change around in SOP regulations. Let's see how we can structure something that works for everybody.
Yeah, and then it's an owner operator. So you can't buy a business with this program and think that you're going to be a passive owner. this is for you to own this business and run it and be 100% responsible.
Exactly. And even in the case, there's a couple of businesses where it's sort of, there are exceptions. It's like laundromats,
Yeah,
right?
well, right.
So, but, so I just closed on a couple of these where the people have outside employment. One of them's a mechanic. He
Yeah.
works on jets for the US military, right? And he is an owner-operator. He's managing the monitors day to day. He's going down there. He's fixing the equipment as it comes, right?
Right.
Great buyer, but you do find people out there who are like, oh, I'll just buy this business and passively run it.
Right.
So SBA is looking for active management.
So, as we like to say on our side of the table, it depends, right?
It depends, yeah.
So, a lot of times it depends on the business. So, in that example, you could be an owner-operator, but unless you're going to sit there and watch the wash cycles or and the laundromat, not you don't have to be there 100% of the time. But for most businesses, you do. And the premise is that this is not it's an investment vehicle in that it's funding. But if you're thinking you're going to go buy a $5 million business and not show up and hire a general manager and just live off the proceeds of the profits, that's not what this is for.
I couldn't say it any better myself.
Okay. So, collateral.
Yeah.
So, let's talk about that.
Yeah.
That has changed over the time, as well as the personal wealth tax has also changed over time.
Yeah.
So, collateral, now this is where we're going to get into a couple of terminology issues, right?
Okay.
So, an airball.
An airball. Oh, you know the term airball. Okay, let's go for it.
So, when you're talking about collateral, the business is going to have, say the business values for $1 million based on its cash flow, and say there's only $100,000 worth of hard assets that the lender can. That leaves the difference between the million and the 100,000 at 900,000, and you're going to have to guarantee that, and the lender's going to look for reasonable assets to secure on that 900,000 other than your John Hancock and your personal guarantee, which could include all the real estate that they own.
Your primary residence, your rental property, right? And that airball, to use easy math, right, because we like to do that, is going to be 75% of the uncollateralized value.
Right.
So it's going to be the airball for the lender. So let's say it's $1 million, right? $1 million collateralized. 75% of that is guaranteed. So our airball left over is 250. Now, if we have 100 there, we're pretty well covered. We only have 150 airball.
Right.
But as these deals get larger, you have that same buyer. Now it's a $3 million company. Lender's going to look at that a lot differently because they're going to have a bigger airball out there, right?
So they've got more collateral to go. So talk a little bit about, in the last 24 months, I've seen life insurance required to life insurance not required, and I think we're back to life insurance required. Is that correct?
Where I think it's smart. I think it's really smart when you have a buyer without a partner there who can run the operation. So if something happens to my buyer and they get hit by the proverbial bus, right? That debt's coming due, and that's on the family and the estate. And so you will, if you're issuing life insurance, if you're requiring life insurance, it's usually when there's one person, so it's your key man there, and you want to get key man life insurance if something were to happen to cover that debt, so it's not undue to the family, right?
But does the lender require? Is it a lender requirement? I mean, it can be a lender requirement. I've seen it all the time, but is it an SBA requirement again?
Not necessarily.
Okay.
I will sometimes, for example, a transaction I'm doing right now fits that, right? It's a couple $1 million. You have one guy who's running the shop of the business. If something happens to him, he's going to want to have it. Did I make it a requirement? I didn't. But on the back end, I told him to get life insurance for his family and to get that covered. So if something were to happen, that debt could be paid off and wouldn't be an undue burden to the family. But I didn't necessarily make it tied to it. But sometimes I will.
Okay.
Especially if we're in an uncollateralized, the higher uncollateralized position is. And unless you have two partners going in there and buying a business, just one person, a lender's more likely to require life insurance.
Okay. So again, it depends.
It depends.
Right. Okay.
Right, it depends.
And then anybody that has 20% ownership still has to guarantee the entire loan.
Right. And if you're coming to me and you have a really fancy structure where you're 51% and you have a couple partners at 19%, we know you're trying to get around those guidelines.
Yeah,
so
right.
you might just be asked to guarantee the loan in that case.
In that case,
Yeah.
anyway. Okay. Well, I do think key man life insurance policies are smart, and
I think so,
especially
too.
for if you're a younger, not my age, if you're a younger borrower going in your 30s or early 40s, term life insurance for just is super cheap these
super
days.
cheap.
Is really cheap, and you should have it. And the
I
business can write it off. I mean, that's a legitimate
It's
business.
a business write-off, and I always recommend people to get the life insurance. Now, whether or not I require it is a different thing.
Yep.
There's a lot of monitoring with those policies, so if I don't have to require it, I may not. But on the backside, as a lender and somebody who's responsible, cares about my clients, cares about the outcome, something were to happen to them, their families, the community, you want your buyers
Yeah,
to have
for sure.
Smart financial planning out there.
And then just any underwriting updates where it's collateral or credit or insurance that have come through in the last 6 to 12 months.
Yeah, great question. In the latest update, one of the things that's happened that is impactful is SBA used to have some flexibility for loans this is a loan amount for under $500,000 where they could choose to take collateral or not choose to take collateral. That's been lowered. That threshold now is $50,000.
Oh, really? Okay.
Yeah. So what we're really kind of getting from that is a tightening of collateral requirements around SBA lending.
Right. Well, Jani, thank you so much for stopping by. I really appreciate you coming by and just sharing some knowledge. I'm going to leave Jani's contact information, how you can get a hold of her to help you structure transactions before you get into trouble down the line, in the comment section below. And again, I just can't tell you how much I appreciate you stopping by the channel and sharing some knowledge today. So thank you.
Well, thank you for having me.
You're welcome. I'd like to thank Jani for stopping by the channel today and not only sharing her knowledge of SBA lending, but her passion in helping clients put together and structure a transaction that works for both parties. Now, I've left Jani's information, contact, and email in the section below, and you can contact her directly, or if you've got a question, please just leave it in the comment section below, and I or Jani will get back to you in a timely manner. I hope you found this episode interesting, and if you did, hit the like and subscribe button, and with that, I'll see you guys on the next episode.